The next topic what we have is pricing approaches. What are the various pricing approaches is what we will look into. Um, the list of pricing approaches are given here: cost plus pricing, price skimming, penetration pricing, linking pricing decisions for different products, volume discounts, price discrimination, relevant cost pricing. So these are the pricing approaches which are mentioned. Let's understand each of them one by one. The first one is cost plus pricing. All of us understand this concept of deciding on what is the selling price. Cost price plus profit is the concept. So wherein the total cost is accumulated, it's pulled up together, find out what is the total amount of total cost divided with number of units gives us what is the um, cost price per unit, add a profit margin, whatever is the desired profit, add that and decide on the selling price. So that anyway we understand that what is that concept of deciding the selling price. The conventional traditional method of deciding selling price is first spend whatever it is that accumulate or whatever would be spent in future also, accumulate all this cost. After that, add a profit margin, decide on the selling price. There are certain other ways also in which selling price is decided. That is, there is MC, TAC or prime cost. These three things are also considered. What is MC? MC is the marginal cost. Marginal cost is the variable cost. So by now we understand what is variable cost. So variable cost is the marginal. Um, Both of them are same in case of accounting. Of course, economics there is a slight difference, but in case of accounting, marginal cost and the variable cost are interchangeably used. So what does this concept say? So the concept of it says that selling price can be decided by only considering the marginal cost plus the profit margin. But why would they do so? See, the selling price should be able to recover all the fixed costs. Since we have already learned about the cost volume profit analysis, we understand that at a point on the scale of operations, we see that let's say that so this is the maximum capacity level starting from zero number of units. Assume that they are this is the present capacity level. Let's put it as 60% capacity. So they are utilizing 60% capacity level, producing and selling these products. Okay, so they still have another 40% capacity available so that they can take up the production and sell the goods. Fine. Right now they are operating at 60% capacity. So when they are operating at 60% capacity, producing the products and selling them, so they would accumulate the total cost. But right at the point of zero number of units only, we see that fixed cost is already incurred. We know that we have already understood this concept. So fixed cost is already incurred. Then proportionately the variable cost also is increased. So at this point of 60%, we see that both the variable and fixed costs are already incurred. So add them up, fixed cost plus variable cost together, that would be the total cost. So total cost is added and then the profit margin is added to that, and then the selling price is already decided. Let's say they are operating at this capacity level, so we are only talking about that. So the selling price which is decided when they have already started operating at 60%, that selling price has taken into consideration both the variable cost and the fixed cost until that point. So now fixed cost from 0 to maximum number of units, it is the same. It would not change again. So all of that fixed cost was already taken into consideration. And until that point, whatever is the variable cost, that was also taken into consideration. So the total cost takes care of the total variable cost and the total fixed cost, and the selling price is decided. Now, at this point of time, let's say that they receive another order, so that now they have spare capacity. Yes, they have spare capacity to the extent of 40%. If spare capacity is available, and if they have to spend cost on production, if they take up the additional production, it would be only the variable cost which increases. No more fixed cost will increase, because fixed cost will remain the same until they reach 100% capacity, and the total fixed cost was already taken care of at the present level. Present level when they are producing and selling, that was already taken care of it. So the spare capacity, when they are utilizing that spare capacity, producing additional products, at that time, all what they would be incurring is only the variable cost, no more fixed cost. So when they are spending only the variable cost or only the marginal cost, selling price can be as low as marginal cost plus profit. Here it is the total cost. This cost price is total cost of the product, total average cost per unit, total average cost. So all the costs are taken into consideration, the variable plus the fixed. Fixed is already absorbed, so only the variable, henceforth it will be only the variable cost which will be incurred. So variable cost plus the profit margin gives us what is the selling price per unit. I hope you understood the concept. So another thing is, take all the prime costs. Prime costs are taken. Prime costs are basically the sum total of all direct costs. All direct costs are variable costs. So another term, that's it for marginal cost or variable cost or direct cost or prime cost. All of them mean the same. It is just another term which is used. So cost plus profit is the conceptually it is the concept of adding a profit margin. Okay, target markup or margin is added to the cost price, and the selling price is decided. So selling price is equal to cost price plus profit margin. Calculate price using target markup or margin, often used as a starting point even when using other methods. What are the advantages? It is a simple and widely used. It's easy to calculate, easy to ascertain what is the selling price, widely used and accepted concept, simple to calculate if costs are known. Selling price decision may be delegated to junior management, because it is just that accumulate the cost, add a profit margin, and decide the selling price. So anybody can take up this particular concept of deciding on what is the selling price. Justification for price increases. Um, See, whenever costs increase, the selling price also will be increased, and then it can be very clearly explained to the customers also, or the stakeholders, that this is the reason why the price has to be increased, because the input costs also have increased, material, labor, and other things have increased. Therefore there was a need for them to increase the selling price. Easy to explain that, justify that. May encourage price stability. See, it may encourage the price stability in terms of see the how much is the cost price, how much is the profit margin. So they can also go ahead and then make a compromise of about the profit margin. See that the selling price is constant. If the cost price increases, maybe if it is possible for them to accommodate, they will adjust upon the adjust on the profit margin, and stabilize the selling price. So that is the concept there. What are the disadvantages? Ignores link between price and demand. See, it is not always that how much have they incurred and what should be the selling price. So there is a very strong correlation between price and demand. Whenever there is a change in price, that affects the demand. That all of us understand that. See, when the price rises, the reaction from the customers is customers move to the competitors' products, or they stop buying, or the demand decreases. When the price increases, demand decreases. So it is not that price can be all the time adjusted because of what is the cost which is incurred. Price change in the price will have an impact on the demand. So that is the main thing. So it is not as simple as it looks, that it can be easily calculated by adding a profit margin to the cost price and decide on the selling price. It is not that simple, because it says that when there is a change in the price, there is an impact on the demand. So not ignoring that. See, that cannot be ignored. If that is ignored, that can be a disadvantage. It is not just that there is a relationship between what is the cost price incurred and what is the what is the selling price decided. Then no attempt to establish optimum price. Optimum price is, um, see, decide on to what extent can they increase the price. It There is no such thing. Um, as much as the increase in cost price is there, the selling price is also increased. So there is no attempt made to optimize the selling price. Which absorption method? Um, the absorption methods, like there are two methods. One is absorption costing method, and another one is marginal costing method. So absorption costing method and marginal costing methods are different in terms of how the ending inventory is valued. So absorption method is also called as the total cost method. So when the ending inventory is valued at that time, the total cost is taken into consideration and it is charged to the ending inventory. But marginal costing method only charges the value of marginal cost to that. So there is an impact on what is the total cost which is accounted for the current period. See, the T form of account, we see that we have opening stock, then we have the purchases, opening stock, then purchases, then wages, then etc. There are so many things. On the credit side, we see that sales and the closing stock. So there are two different methods of valuing the closing stock. One is absorption method. Another one is marginal costing method. Absorption costing method or marginal costing method. Absorption costing method charges a higher amount for closing stock, because both the variable and the fixed costs are charged to the closing stock for the moment, because you have not learned that, or I don't remember whether you, if I'm not wrong, you should be learning that in management accounting. I'm not sure whether you know that it or not. But the point is, under absorption costing method, closing stock is higher. When the closing stock is higher, so the cost of production is all these opening stock plus the production cost minus the closing stock. So higher amount is deducted, and the cost of goods sold, we see that it is lesser. But in case of marginal costing, lesser amount is charged to the closing stock. So the cost of production would be higher. So then deciding the cost price plus the profit margin is selling price. But cost price, how would it be decided? Whether it would be based on the total cost method, that is absorption costing method, or only the variable cost, which is the marginal cost method. So that is also not explained. Which absorption method, that is also not explained. So that becomes a disadvantage. Does not guarantee profit. So it does not guarantee that based on this method of deciding the selling price, the profit is not guaranteed. What does it mean? We've learned about a ABC technique. So when the cost is charged, the cost could be charged based on predetermined overhead rate that we have already discussed. So if that is the case, the right amount of cost, when it is not decided, on that a profit margin is added, it may not be the right amount of cost, the actual amount of cost. So there is no guarantee that profit will be earned. Okay, which cost, that is about the variable cost, the fixed cost, um, the predetermined overhead rate, used, or activity based costing. So what are the costs which are to be considered? That is not clear. Inflexibility in pricing, circular reasoning. See, the because the cost price has increased, therefore selling price has to be increased. um, so it goes on justifying that way, but that doesn't work out, because that is not the only reason what can be accepted by the customers about the increase in selling price. So these are all disadvantages in terms of cost plus pricing um, concept. Then we see the next one, price skimming. The next one is price skimming. What does it mean by price skimming? See, when the product is launched in the initial stages, we see that the product is launched at a high price. Later on, they go ahead and then reduce the price. So that concept is called as price skimming. We see this concept in almost all the electronic products and the the latest thing, the mobile phones, the cell phones. We see that when the products are launched, they are launched at a higher price. Later on, after a while, after some time after the product is launched, the prices are brought down. You must have experienced that. Whatever model you buy, um, after a while, we see that the price is reduced. What is the reason? Why does it happen? See, if they anticipate that the life of the product would be less, so they want to recover their initial cost, that is research and development cost, the designing cost, all the fixed cost. They want to absorb them, they want to recover them as early as possible. So that's the concept. So they do not want to wait for a longer period of time till they break even. They want to break even as early as possible, because of that uncertainty about the life of the product, because the initial costs incurred are quite high, that they want to recover all of them. So they decide on the selling price at very high price. So once the break even happens, then immediately they also give discounts and then bring down the price of that particular product, or the life of the, if they see that it would not last for a very long time, initial costs are very high, um, uncertainty that it would last for a long time. So that if there is kind of uncertainty also, so their intention is to first absorb all their costs, recover all their costs. Then after that, they are willing to bring down their price. So that is the concept where we see that price skimming is followed. They are set at a high initial price to skim off customers who are willing to pay extra. See, this is possible um, in, see, the electronics, mobiles and all. So it is a prestige for to own certain types of cell phones like iPhone and all. So even if the price is quite high also, customers are still willing to pay for that. So it is a issue of owning that particular, it's a prestige issue to own a particular type of product, a brand of product. So for that reason, they are even willing to pay very high. Sometimes we see that certain things are also black marketed because of because the reason is to own that. uh, okay, for that, if such type of customers are available, they come out with this concept of price skimming. Once the break even point is already achieved, now their strategy would be to attract more customers, so they bring down on the prices fall over time, but it is not suitable for all types of product. Only in certain cases it is suitable. See, not all products when they are launched at high prices, they would be accepted. Some of the only very few products we see that they are accepted even if the price is quite high. Okay, then we see that penetration pricing, the product is set at, quite contradicting to that, the product is set at low price. So set a low initial price to gain market share. So based on the price, many customers get attracted. Once the market share is decided, once they understand the product, the concept of that, and the advantages of using that, or whatever are the best quality features of the product, once customers understand that, they gain the market share. Then slowly they bring down on slowly they bring up the price or increase the price. If a high volume is achieved, the low price could be sustainable, or gradually they can also increase that. See here, um, the concept is to enter into the market, explore the market, attract many customers. Their objective is to gain market share. So at a low price. So low price, see, the sales value can be calculated as number of units into selling price. So we know that if the selling price per unit, if it is very low, they will have to have a strategy of selling more number of units. So unless they are intended to enter into the market, capture the market thoroughly, then it is not possible. So selling price, sales is equal to selling price per unit into the number of units. So by having a low selling price, they would be able to capture the market and increase on their number of units. So that's the concept. If a high volume is achieved, the low price could be sustainable, and it is suitable only in certain types of products again. Um, see, one example we can, we should be taking in this particular context. See, not all the time um, things can be attracted with the low price. See, Tata Nano was launched in the market at a low price. The intention was genuine, intention was very good. Intention was to help the middle class families and to ensure that they can own a car. But did it work out? No, it didn't work out. Okay, so in the automobile car section, see, the intention was to attract more number of customers by way of charging a low price. Low price was, see, right from the beginning their focus was only low price. So there was no other deviation from that. They have intended with genuine interest to help the middle class small families. So this small car was launched. It was launched at a low price. All types of facilities were also given. They can even purchase a card by swiping a credit card also, as simple as that. Just walk into a showroom, swipe the credit card, and acquire a car. It was, there was no other formality also. So it was as simple as that. All types of facilities were given, but yet it did not attract the customers. So just because the price is low, it would attract the customers is not a criteria. It is not a situation. So we do not see that this concept suits every type of uh, customer segment. Every type of customers get attracted. No, that doesn't work out. So we see that. So low prices may not attract because there is one perception of the customers that if the products are priced high, then the quality is high. So that is the perception, value perception. They perceive it that way. So even if the features were the same on par, maybe certain things would be different. It is not that the nano car was on par with any other car, but the comfort part of it was the focus, the cost part of it was the focus. So they have not perceived it in the right sense. They have perceived it of low quality and did not get attracted. Okay. Other cars were minimum 4 to 5 times higher than what nano price was there. So, but the perception of the customers was so very different. That is, generally we see that the perception of the customers, that if the product is of low price, the quality is also assumed to be low. If the product is of high price, the um, value is also assumed to be high. Okay, so penetration pricing, that is the concept. Then linking pricing decisions for different products. Basic idea: product A is cheap to attract customers who then also buy the higher margin product. So by offering a low price product first, they attract the customers, and then they offer other products in their product line. So initially they attract the customers, they gain the customers confidence by attracting them with a cheap or a low cost product. Then later on they also present their other products. So since you have used this one, you would also like to use the other products in the product line, and other products are offered to the customers. The key issue is the extent to which customers must buy the other products. Okay. um, Sometimes they are offered as a combination combo offers. All of you must be quite aware of what are combo offers, one with another thing. So there are certain um, ways in which they attract that. Initially, only one product is offered to them. So along with this product, there are other products also. So if you buy it as a combo offer, then this could be the discount. So what is the concept here is linking of one product with another product, and then attracting the customers, or making them purchase the other products. Sometimes they are irrelevant also, just because it comes in a discount offer also, customers do buy because it is a discount offer, because it's a combo offer, because it is providing certain things which may not be their requirement at that point of time, but yet they tend to purchase that, and they get attracted to that part of it. After that, we see volume discounts. When uh, the quantity purchased increases, the price also differs. See, one product which is purchased, um, it's at the same price. Or apparel stores, you generally see that one t-shirt is purchased, 10% discount. Two t-shirts are purchased, then you see that 20% discount on each of them, or something like that. So then three shirts are purchased, or 3 units of the apparel are purchased, or something like that. Only shirt has one price, only pant has another price, pant and shirt together has a different price. So more in quantity, discounts are more. So in case of business, when the inventory which is purchased is at a higher quantity, the price is a different one. So there is a discounted price which is offered. See, if it is purchased at for the few units of that particular material, the quantity is less, no discount, it is available at the listed price. But if they purchase more amount of inventory, the quantity of inventory, if it increases, in such cases we see that the discount is offered. So discount for individual order, large order, cumulative quantity discounts, and then it should be suitable for the business also to go in for that. If huge amount of discounts are given, see, units into selling price per unit, it just because units are increasing, the selling price is uh, reduced, decreased. In that case, there may not be left with any benefit. Units is increasing, selling price is decreasing, the overall impact would not be there so much. So they also have to check about what is the suitability of this particular concept of giving a discount on large volume purchases. Then price discrimination. Price discrimination is a concept where the same product is available, or the same product is sold in different markets and different prices. See, on the products you must have seen that um, this is the price in these two states, and the rest of the India the another price. So the same product can be sold at different prices in different markets. We see that petrol is one example. We see that it is the same product petrol, but in different places, different states, we see that the price is different because of the state levied tax, high tax, low tax, no tax, or whatever is that. We see that. Okay. Liquor is another example what we can quote. So liquor is not uniformly the same price which is offered by all state governments. Each government, they have their own strategy about selling the liquor. They are available at different prices. So there is a price discrimination based on the geographical location of the market and etc. So have different prices in different markets for the same product. What is relevant cost pricing? Relevant cost pricing, like in the initial stage we have discussed about, it could be the cost price plus profit. This cost price is the total cost price, or it could be the marginal cost, or it is also the relevant cost, only the relevant cost. But what is relevant cost? We will be looking into what is relevant cost in a short while. Okay, we will be looking into that. But what is relevant cost is, see, the classification of cost goes as variable cost and fixed cost. So the relevance part of it, if we are looking into relevance for what? Relevance for decision making. Let's say if there is a decision taken to increase the output, so which cost increases? Only the variable cost. Decrease the output, only the variable cost decreases. Fixed cost remains same, it is the same until it reaches the 100% capacity. So in terms of relevance for decision making, variable cost is relevant for decision making or cost control or anything. Fixed cost, because since it remains same, it is absolutely not relevant for decision making. Now if that is the case, um, we see that variable cost is a relevant cost, but fixed cost again is um, um, categorized as avoidable fixed cost or traceable fixed cost or direct fixed cost. What these are the terms what can be used. So we have traceable fixed cost, then unavoidable fixed cost. So fixed cost also can be categorized as traceable fixed cost. Then we see unavoidable fixed cost. Like when the activity is altered, a portion of the fixed cost also can be controlled. Like if they take out on a smaller premises um, from larger premises, see the rent paid, factory rent paid is a fixed cost. But until now, if they are utilizing a bigger space for their factory premises, the cost is definitely high. But maybe they have outsourced, or maybe some decision was taken and then they have cut down on the activity. When they have cut down on the activity, they would no longer requiring, maybe that they would no longer require such a big premises, so they can move into a smaller premises. When they move into a smaller premises, it will be cost effective, cost will be controlled. So basically factory rent is a fixed cost, but a portion of the fixed cost now they are able to eliminate, avoid that. So we see that traceable fixed cost plus the variable cost, both of them can be controlled because of a decision. See, by taking a decision, there is a cost control possible for traceable fixed cost also. Right? So the relevant cost is the variable plus the traceable fixed cost. So take the relevant cost. plus the profit margin gives us what is the selling price under relevant cost price concept. So let's see the next chapter, relevant costing. Let's look into that and then try to understand what is the concept of relevant costing. See, we have just now understood about what is the concept of what is relevant cost. The variable cost plus the traceable fixed cost is called the relevant uh, relevant cost. See, there are certain unavoidable fixed costs. Some decisions which were taken in the past, or some decisions that some portion of the total fixed cost has to be borne by a particular department or a division. They are absolutely not controllable, uncontrollable. So, in that case, they are also called as unavoidable fixed costs. Under that, we have committed fixed cost, allocated fixed cost. These are costs which are incurred, which have to be charged to the department, but it is not. They have not incurred that. They just have to bear it because somebody has taken a decision about incurring the fixed cost. For example, if suppose somebody enters in the past, there is a agreement of entering into a lease agreement. What happens when they enter into a lease agreement? They have to pay lease payments or rent payment, whatever we call that, as long as the lease period exists. Suppose there is an agreement to be in an agreement for 10 years. So 10 long years they have to pay the lease amount. There is no there would be no avoiding of that or cancelling of that. The commitment is for 10 years. So 10 years, the amount has to be paid. So it is a commitment which is made. Asset, when it is purchased, it is the depreciation also which is decided. As long as the life of the asset lasts, the amount of depreciation also has to be shown in the books of accounts. So we see there are certain commitments which are made, certain items which are decisions which were taken in the past. Therefore, to that extent, they have to keep charging these costs in the books of accounts. So, what do the relevant costs include? We see that the variable cost, okay, um, for the relevant cost. For the relevant cost, we see the variable cost plus the traceable fixed cost. Anything which can be avoided, the traceable fixed cost, that is considered. Okay. If at all, if there is any opportunity cost which is associated, that also will be a part of relevance. These are the relevant costs. Based on the relevance, the relevant costs are these are the costs. What are the irrelevant costs? Irrelevant costs are all that is not under the purview of a manager. Like depreciation is not under his purview. Then any allocated apportioned fixed cost, it is not in his purview. He cannot take a decision to avoid them. He cannot see that these costs are not incurred. He cannot alter them at all. Okay, so they are not under his purview. Anything which was incurred in the past, can it be undone? No, it cannot be. We cannot undo any past cost. So sunk cost is also irrelevant. It's already incurred. What can be done to undo that? Nothing can be done to undo that. So therefore, sunk cost is also is an irrelevant cost. then any type of unavoidable costs, no matter what they do. See, even if they close down a particular unit, can they avoid fixed cost? No, they cannot avoid that. So all types of unavoidable costs are irrelevant for decision making. Then any type of financing costs are irrelevant for decision making, because when they have raised the amount, whatever are the terms and conditions, according to the terms and condition, the amount of cost is incurred. Like interest is paid on debt capital, any cost of capital, finance cost, all finance cost basically, dividend is paid to the shareholders. So they are not relevant for decision making. They have to be incurred, so they are incurred in the firm. How is the decision about what is the relevant cost decided? There are two slides, two examples which are quoted here. We see that if in case of material, if a decision has to be taken, how do they verify the checking part of it? It starts with, are the materials already in inventory? No, if they are not available, they have to purchase. So what is the relevant cost? Cost of purchase is the relevant cost. If they are already there, they do not have to purchase. Then in that case, then the question arises: the material which is already there in the premises, can it be used or it has to be replaced? If it has to be replaced, then the replacement cost of the inventory becomes relevant cost, because now they have to spend some amount to replace the old material. Will they be replaced? Yes, then replacement cost. No, then will it be used for some other purpose? So if this material, if it would be diverted to some other um, product or some other process, then whatever is the contribution which they will forego, the profit which they will forego becomes their opportunity cost. So that is relevant for decision making about should they divert this material to some other product or process. So that part of it is the relevant decision making. See, net realizable value, if they do not, if they are not utilizing it for some other purpose, when they sell that, how much is the net realizable value? That has to be looked into. So like this, every step, every stage, what is the decision which is involved and how decisions have to be taken about their relevance is, this is one example. Another example, cost of labor. Do they have labor? Spare capacity is available? Yes. Then they don't have to spend anything else but just utilize the spare capacity. If they do not have spare capacity, then spare capacity in terms of the hours available, labor hours which are available. So the workers are present in the organization, but they do not have sufficient work, but they have paid full wages. So in such situations, if they are considered, is there any spare capacity is what has to be looked into. If spare capacity is available, then they need not be paid anything extra within the work hours. Um, the task is assigned and they can complete the task, and no additional cost need to be paid. Can additional labor be hired if they do not have spare capacity? Do they have additional requirement to hire additional labor? Then when they hire additional labor, cost of labor becomes the relevant cost. If they do not hire additional labor, then what do they do? Um, they can either stop production of some other product or delay that product or some way. they take it up, and then whatever is the decision on account of that, if there is any opportunity cost arising, that becomes a relevant cost. The next decision is about make or buy. What does it mean by make or buy? See, some of the products are basically assembly of many components. Um, See, the watch which we wear, wrist watches, the products like motorbike, car, um, see, um, I think your laptop. These are all products wherein they are assembled by bringing together many components, and the final product is manufactured. It is made. So now, when their multiple components are brought together and assembled into one product, the decision is not about the final product. We are not discussing about whether the final product should be bought or it should be made. It is about the components that are used in the manufacture of the final product. If suppose the watch which is worn by, I mean, the watch which we use, if it is a leather watch, for example, let's see that. See, the leather watch has how many components? We see the main watch engine or motor or whatever we call that. There is a glass frame. In that, we see there is a dial wherein steel rods are placed, and sometimes stones are pasted there. Or see, there are certain other components like apart from that machine, or the watch machine or the motor, whatever we call that. Then frame is there, the dial is there, then steel rods are there, some stones or some fancy things are there. Then we see glass covering is there. Then let's say if it is a leather watch, then we see that leather is there. Then buckles are there. If it is a steel watch, that particular material is there. And we see there are many types of metals which are used for the strap. Then all these components, when they are brought together, when they are assembled, then we get this final product called as a wristwatch. You can take that example for any type of product. See, if a bike is taken, bike engine is there, then we see steel rods are there, seat, the seat is leather seat is there, then we see rubber handles are there, mirrors are there, okay, um, some iron is there, some steel is there, um, tires are there, tubes are there. So all these components, when they are brought together, then there is one final product called as motorbike, which is assembled. So in this, when there are multiple components which are used and they have to be brought together, in that case, the decision is about any one component, whether it should be made or purchased. Why should we even consider that? See, whatever is their main expertise, so somebody who's dealing with manufacturing of motorbikes, so they are more, their expertise lies with manufacturing the motorbikes. But if they have to use that rubber for the handles and all. See, to make those rubber handles, or to make a mirror which has to be placed, or to make those seats out of whatever is the material which is used, resin, leather, whatever is they use. Those kind of equipment also has to be installed, and using that equipment, they have to make these components. Okay, but what is their core competence or core expertise? It is about making the main part of the product. If engine is the motorbike engine, or that is their main component, but all the other components are also needed so that the final product can be made, but their expertise doesn't lie in that. So somebody who's dealing with leather products, manufacturing of leather products, for them it is much easier to make the leather seats for the product. Okay, they have the equipment, they are dealing only with leather products, so for them it is cost effective also, so they can provide these seats at a cheaper rate than when otherwise manufactured by the business. So here what do we see? We understand that um, some of the components, if they make for them, they, because they do not have that expertise, it is costlier for them. But an outside supplier, this, for the supplier it is cheaper, because they are dealing with that, it is their core competence. Somebody dealing with mirrors, they can make it at a cheaper cost, because economies of scale and all, so it is possible for them to make it at a cheaper cost. So the decision about whether to make or buy, so if it has to be bought, how do we take a decision? The decision part of it, if it is made, if it is bought, if it is made, we see that variable cost is incurred, then the fixed cost is incurred. If it is bought, if the product has to be bought, buying the component, buying that component from the supplier. So whatever is the price offered by the supplier, supplier's price is the price which is incurred. Okay, just because they are not making the component, will they have any benefit in terms of avoiding fixed cost? Fixed cost will remain the same. Fixed cost will be incurred even if they are buying the component from outside supplier. So the relevance here is about the decision which is based upon fixed cost. In either situations, we see that it would be incurred. There is no change in fixed cost. Fixed cost in any case, it will be incurred. So the decision is basically between the variable cost and the supplier's price. Okay. So whichever is cheaper, whichever is cheaper, we go with that particular decision about either to make the component or buy the component from outside supplier. So that is the decision what has to be taken. Second. So there are numerical questions also, we will take it up. But let me first explain all the other concepts also under relevant costing, and then we will start. When I look into the examination kit, we see that examination kit has one or two questions about make or buy. But the entire section we will take it up now about the short-term decisions. Whatever are the questions, we will be considering that. Question number 128. But then first, we will discuss about the other things also. So the relevance is about the relevance is about what is the variable cost and what is the supplier's price. Of course, there is some other adjustment also which is connected to this one. See, if they are not making on an advanced level, let's say if they are not making, uh, maybe we can illustrate here. If the variable cost is 5, the fixed cost is 2, and the total cost is 7. Let's say that manufacturing, making the component stands at 7. Then if the supplier is offering a price of 6, so should the product be purchased? A very basic question. See, let's say that to make to make the component, it is 7. How is this 7? Is 5 is variable cost and 2 is fixed cost, and the cost of making this component is 7, but the supplier is offering at a price of 6. So should we make the component or buy it from the supplier? Supplier is offering only 6, but the decision would be, see, 7 is the price which is incurred for making, but out of that 2 is fixed cost. So 2 will be continued to incur even when they are purchasing it from outside supplier. So when they're purchasing it from outside supplier also, 2 cannot be avoided. So 2 is completely irrelevant. The decision is about 5 versus 6. So which one is better? Making is better. So the total cost is not 7 versus 6, but 7 versus 8. 8 is the cost, because fixed cost also will be incurred. So the decision will be about 5, that is the variable cost, versus the supplier price. Supplier price is 6. So the decision would be for making the component, not buying it from the supplier. So that is a basic level example. Of course, going ahead, we would also see that if they are not making, let's say that if they are not making, what will happen? Certain resources will be available. Machinery will be there, labor will be there, so they can be utilized. So if they are not making the product, these resources can be put to some other use. So that is at an advanced level, the adjustment. I think the question what we are going to look into that has a concept where if they are not utilizing these resources, they can put these resources to use for some other thing. Maybe space is available, they can rent it out to someone and earn some revenue. So like that, certain adjustments can be also included. In that case, how do we take the decision? If that is the situation, we have a concept of an opportunity cost. When we take up the question, I will explain to you that opportunity cost. For the moment, you can look into one basic example. The example is about making or buying. Making, the variable cost is 5, fixed cost is 2, total cost is 7. An example. Uh, the supplier is offering at a price of 6. It is not profitable because we have to eliminate the irrelevant cost, which is fixed cost of 2. So the decision would be between the variable cost and the supplier's price. So 5 versus 6, and then 5 looks very attractive. What if the supplier offers it at 4.5? Then it is feasible to order it from the supplier. What are the practical factors in make or buy decision? Very important point of it is the quality aspect has to be taken into consideration, because when it is made, whatever is the required quality, that will be taken into consideration. The in-house manufacturing, they will take care of the quality part of it, but when it has to be purchased from outside suppliers, the quality cannot be given. See, the quality would not be according to what they are expecting. Whatever is the quality which the supplier is offering, it has to be accepted. See that ensuring that the quality standards are maintained may not be possible when they are purchasing it from outside supplier. See, when they are not making, some of the resources will be available, like one of them will be the human resource, that is the people who are already employed. They are employed, they're working in the organization. Now that they would no longer be manufacturing the component, then they will have to remove these employees from their job. So what about the skill and competence which is available, the skill and competence which is otherwise available, um, which they were using, now they have to forego them. They have to um, remove them, lay off them, lay them off from their roles. So that arises to a ethical aspect also. See, if they can put them to alternate use, if they can be placed in some other position, some other role, some other job can be assigned to them. If they can be put to alternate use, then that's fine. But if they cannot be put to alternate use, or they cannot be placed in some other role and some other job can be provided to them, then that again arises the question about is it ethical that they are removed out of their job. So there are certain social and ethical aspects which arise because they are outsourcing the product. So they're outsourcing this to some other supplier and then stopping the manufacturing um, of the component. Confidentiality and legal aspects, the next aspect. See, whatever, if everything was made in house, the details about their production and other things are confidentially maintained. So everything is there in house, nothing needs to be revealed to anyone. But if in case, if in case they are sharing this with others, see, external supplier with them, if they place an order for some number of components, so that is an indication that they require this many number of components because of their production of the main product. Other details about what quality aspects they are maintaining, all these things will be revealed to external entities. So the supplier gets to understand what is their production plan and other aspects. So there's nothing confidential then. So that confidentiality would not be maintained. Operating gearing is a concept which is looked into about what is the proportion of the variable cost. Now, gearing is a situation which is the proportion of cost between variable costs and fixed costs. What are the variable costs? What are the fixed costs? So, the proportion of these two, uh, since we've learned cost volume profit analysis, so we understand this better about the variable cost and fixed cost. See, and after they recover their fixed cost, there is no more fixed cost. It's only the variable cost which is incurred, and their they are safe beyond the break even point. There's margin of safety, so the profit will be as much as their contribution margin ratio. Okay. So if they have fixed cost, the proportion of what is the amount of fixed cost, what is the amount of variable cost also, we'll talk about whether they can go in for outsourcing with the outsiders, outside supplier, or outsource the component to an with an outside supplier. That aspect of it. See, if they have more amount of fixed cost, then um, their fixed costs are quite high. In that case, is it possible that they can think about outsourcing? See, the making part of it, we see that there is variable component, there is fixed component. Then for buying it with an outside supplier, there is fixed cost. Then the supplier's price. So if let's say that this fixed cost is very low, the major part of it is variable cost. So the decision can be between variable cost and supplier's price. If the fixed cost is quite high, variable component is very low, then in that case, then the supplier price and the variable cost, when we are comparing that, it is always that the variable cost may look quite high or low, or the decisions will be then it will have an impact on what is the decision about to making in the in-house, or making or buying it from supplier. So the proportion of fixed costs also is bent towards one particular thing. If it is very low, if the fixed cost part of it is quite low, the decision is completely dependent on what is the proportion of variable cost and what is the supplier's price. And very low, a major part of it is variable cost. So supplier's cost price may be cheaper. Variable cost is quite high, so supplier's price would be cheaper. So then the decision is bent towards buying it. Then if the fixed cost is quite high, then variable cost amount will be very low. Variable cost amount is very low, then the decision would be dependent towards or bent towards the making of the component. So what is the operating gearing also is one important factor about whether they should be making it or buying it. Okay, how do they schedule? Scheduling part of it talks about um, see the schedule about how the work they assign, or what is the way in which they final finished product has to be produced. So how quickly can the supplier supply the components, or how much time does it take for them to finish their work if they manufacture within the organization. So that is again one aspect which has to be considered. If the supplier requires a lot more time, then they make it then it is not suitable for them to go for purchasing it from the supplier. See, sometimes customers may not like that components are purchased from outside suppliers and then they are assembled. Maybe because they do not like the supplier, or they are not happy with the component of that, the quality of that particular component. So there could be certain reasons why the customers do not like or not like, or they may also be happy that components of some particular reputed companies components are used, they may be happy about that. So that is also one important factor which has to be considered in case of make or buy decisions. I will make you work one question on make or buy. um, okay, we'll do it, we'll work it out and then see under make or buy we have there's one question, question number 128, which is suitable for this particular scenario. Question number 128. P is considering whether to continue making component or to buy it from an outside supplier. It uses 12,000 of the components each year. The internal manufacturing cost comprises direct materials, direct labor, variable overhead, specific fixed cost, other fixed cost. If the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of 10 per unit but requires 8 of labor per unit. What is the maximum price per component at which buying is preferable to internal manufacture? It is not a very simple question. There is an adjustment which is to be considered. Any point of time, if you feel that you're not able to understand, stop me. Don't hesitate. The concept is the same, that is to make or buy make the component or buy the component from an outside supplier. The requirement is 12,000 components each year. Then the list of items which are given. We see direct material, direct labor, variable overhead. These three items are variable in nature. So these are variable in nature. Variable cost. All direct costs are variable costs. So direct material, direct labor, variable overhead, all of them are variable cost. Then there are two items: specific fixed cost, other fixed cost. So two other items are there. Specific fixed cost is a direct fixed cost, relevant fixed cost, traceable fixed cost. So this is relevant costing. So what is relevant? Relevant is specific fixed cost is also relevant. So if we are talking about what are the relevant costs, we should consider all of them, the set of this. Only the other fixed cost is irrelevant for decision making. specific fixed cost is very specific to manufacturing of this particular component. If it is manufactured, it would be incurred. If it is not manufactured, it will not be incurred. Okay. But if that mention is not there about specific fixed cost, we would not consider as relevant cost, because it's very clearly mentioned that specific cost, direct fixed cost, relevant fixed cost, then it will also be considered as relevant cost. Okay. So what's the sum total of that? It says that 3, 4, 7, 8, 10.5. 10.5 is the relevant cost. Now the decision. So let's start with that. Apart from this set of information, there is another paragraph also which is given. We will look into that and then talk about what it is. So I hope you are able to see the Excel sheet. You're able to see the Excel sheet. Respond.
Yes,
Am I
ma'am.
audible?
Yes, ma'am.
Okay. So let's list out all the costs. First is direct material. Then we have direct labor. Then we have variable overhead. Then we have specific fixed cost. And then other fixed cost. Okay. Direct material, direct labor, variable overhead, specific fixed cost, and other fixed cost. So all these costs are incurred for making that. 3, 4, 1, 2.5, and then 2. So cost of making it 12.5. No, let's wait for some more time. 12.5. See, then if the direct labor were not used to manufacture the component, so there is one particular thing which is direct labor. If they do not make, so the present situation making the component, they require $12.5. So that's there. But if, let's say, if they take a decision about buying it from the outside supplier, in that case labor will be available. In that, this labor can be put to use in some other case. If the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is an unlimited demand. So all this labor can be diverted. So this 4 cost, whatever they are right now incurring, this can be utilized elsewhere. Okay. In that case, there is some additional contribution which can be earned. This other item has a contribution of $10 per unit but requires $8 of labor rent. They will be able to earn additional contribution. But by making that, can they earn that contribution? They cannot, because labor is used for making this component. They are using the labor to make this component. So there is no way possibility that they can earn that $10 contribution. So they're foregoing that. When they are making that, there is an additional cost that is not being able to earn that contribution is for additional cost, opportunity cost for them. So that is also one cost, opportunity cost. That's the adjustment. So we have to see that just because they are making, they are foregoing this contribution of 10. Anything which is foregone because of a decision which is taken, that is called as opportunity cost. Not being able to get that benefit is the opportunity cost. Foregoing that benefit is the opportunity cost. Okay. So if that is the opportunity cost, that also has to be included here. Okay. It says that if the direct labor were not used to manufacture the component, it would be used to increase the production of another item for which there is unlimited demand. This other item has a contribution of $10 per unit, but the requirement is $8 of labor per unit. As of now, how much labor are they using? They are using $4 of labor per unit. So when they are using $4, they will be earning contribution only to the extent of $4. When 8 is used, 10 is the contribution. 4 is used, 5 will be the contribution. Okay. So that is an opportunity cost. Opportunity cost or contribution foregone. Contribution foregone will be, say, all 10 will not be their contribution. 10 is when $8 labor is used, but here they will be not using only $4 labor. So 10 divided by 2. I hope all of you got it clear. Otherwise, ask me, I will once again explain. Is the supplier's price given? Supplier's price is not given. The question says, what is the maximum price per component at which buying is preferable to internal manufacture? So when will it be better that buying is better than making it? So when the cost which is incurred, when the cost which is charged by the supplier is when is it better when the cost which is incurred to make that is higher than what the supplier is offering. In such situations we see that it is the total cost is 17.5, what we got it as cost of making is 17.5. Let's say if the supply, if it is purchased from the outside supplier, in that case out of all these costs there is one cost which will be incurred, that is other fixed cost will be incurred. So the relevant cost plus the opportunity cost is 17.5 minus 2, which is 15.5. So if the price is, so for the decision making, we see that decision making for making relevant cost is, we have it as all these costs are relevant, specific cost. All these costs are relevant. Then opportunity cost, we have it as 5. So the total decision is about 15.5. The relevant cost for decision making plus the opportunity cost together it is 15.5. So if the supplier also offers 15.5 or less than 15.5, it is feasible. If same price is offered by the supplier, it is an indifferent point. Anything is okay, whether they make it or whether they buy. Maybe some other factors also will be taken into consideration to take the decision. So whether 15.5 or less than 15.5 is the decision criteria. So the maximum can be up till 15.5. So what is the maximum price per component at which buying is preferable? Maximum to the extent of 15.5. It is preferable. Anything 15.5 or less than 15.5 is suitable. I hope it is clear. Is it clear? No one's listening to me. The next decision is shutdown. 1 second. For shutdown, we will take a decision about shutting down the particular unit. Shutdown decisions. The next topic, what is shutdown decisions is um, see, sometimes certain units which are not doing well, certain products which are not doing well. In that case, they have to take decisions about shutting down that particular unit. That is about shutdown decisions. Um, if in this case they shut down, okay, basically when a unit is running, the cost which are incurred are variable cost plus the fixed cost. If they take a decision about shutting down, if they shut down, in case of shutdown, only the variable cost will not be incurred. So variable cost will be zero, no amount of variable cost, but then fixed cost will continue to be incurred as it is. The sales minus variable cost is contribution. So contribution will be zero, fixed cost will be the same, and then fixed cost would be the same. So in that case, if a greater amount of fixed costs are there, at least some amount of contribution, whatever is generated, which will be able to recover these fixed costs. If they shut down their unit, if a major part of the fixed costs are still continued, then they are unavoidable fixed costs. Okay, in that case, how do we take a decision about whether it should be shut down or it should be continued? Look at future incremental cash flows, a portion of overheads which are not relevant. If they can avoid them, if there is no unit and there is no cost which is incurred, that can be avoided. So their loss can be cut down to that extent. Then, if there are heavy closure costs, that is when units are shut down, also sometimes we see that there are costs which are incurred to settle the equipment, dismantle that, closing down, or there are certain formalities which have to be fulfilled that the unit is closed down. If those costs are quite high, then rather continue whatever is the way in which they are continuing. It should be continued. If they can put the resources to alternative use, then also it is better to close down. Otherwise, just continue the way they have to continue. Okay. So that is the concept about what is shutdown decisions. Then there is an other concept about joint products. I'm assuming you have no idea about what are joint products because you're still in the second semester. See, when multiple products are produced in the factory, some of the products in the initial stages they require the same production process. So all of them go through the same production process. Initially, let's say that there are three products. All three of them go through the same production process, and the costs which are incurred are jointly incurred. They are joint costs. Then this continues until a point where, at that point, all these products get separated. So the point where they get separated, we call that point to be a split off point. So they get separated at a split off point. So until this point, the work which is completed is only half. They are still in the intermediary stage. There's some more processing has to be taken up. They have to be processed further. So they get separated at the split off point, and the further processing is done. After further processing, they would be sold. Let's say three products are there: A, B, and C. So they would be processed further and will be sold finally. If this is the scenario, now there are many topics which are connected with joint products, joint product accounting. But the situation which is covered in your syllabus is about a specific thing that when the products are split at the split off point, sometimes we see that the products are not fully processed also in the intermediary stage also. They may have a market value. They can be sold in the market in that semi-finished state intermediary product. As intermediary products also, they still have a market and they can be sold in the market. So there is a sale value present at the split off point. If they further process it, final product also has a sale value. So the relevance about the decision making is, should the products be sold at the split off point or they should be processed further and sold after the final processing is done? That is the decision. There are various things about how the accounting is taken care of it. We are not getting into the intricacies about all those things, but we are just looking at one aspect of it, which is should they be sold at the split off point or should they be processed further? How is the decision taken? Um, See, there is a sale value at the split off and sale value at so here the decision criteria would be the difference between the sale value after further processing and sale value at the split off point. We call that to be as incremental benefit. For example, if the product is sold at the split off point for 100, after further processing, it may be sold at 125. So that they would be getting the benefit as 25 more. If at this split off point they sell it, they can get a revenue of 100 per unit for any product. But if the same product is processed further, so then it can be sold at a higher price. So the difference between these two prices is called as incremental benefit. Okay. So incremental benefit should be compared with incremental cost. What is incremental cost? The cost of processing it further. Further processing costs are there. So those further further processing costs. So the comparison should be between the incremental benefit. How do we get the incremental benefit? The difference between the sale value after further processing versus the sale value at the split off point. So find out the difference between these two. That is the incremental benefit. Then compare that with the incremental cost and then take a decision. Let's say for these three products, let's give some imaginary figures. So A, B, and C. Let's take an example. Some imaginary figures. Let's figure it out. So sale value at split off. If you're talking about at a split off point, this has a sale value of 100. Let's say this has a sale value again as, let's put it as 125. This has a sale value of 80. And then take sale value after further processing. Further processing. So here we see that this is 125. This is 150. This is 100. So what should we do? We should find out what is the incremental benefit. Incremental benefit is what has to be looked into. The difference between these two selling prices is incremental benefit. Incremental benefit here is 25. Here also it is 25. Here it is 20. Now incremental benefit has to be compared with further processing cost. Further processing cost is the incremental cost. Further processing cost. This benefit can be earned only when further processing costs are incurred. Here it is 30. Here it is 20. Let's say here it is 15. So when we are comparing, which one should be processed further? So the incremental cost is greater than the incremental benefit. Therefore, do not process it. Sell it at the split of points. Do not process it. But incremental cost is 20, benefit is 25. So additional 5 is their benefit. So process it. This one, process it. The incremental cost is 15, benefit is 20. So additional 5 is their benefit. So this also has to be processed further. So that is how the decisions are taken. If the decision is about selling the product at the split off point or processing it further, the decision will be dependent on what is the incremental benefit versus what is the incremental cost or what is the further processing cost. So when we compare these two things, if the incremental cost is more than the incremental benefit, do not process it. Sell it at the split off point. Whatever value they get, they should be selling it off at the split off point. But if they see that the additional incremental costs are less than what benefit they would be getting it after processing it further, if that is the case, then they should go ahead and process it further and sell it after further processing. So this is one imaginary figures, one example is there. So from this example, we can understand that product A should not be processed further, whereas B and C should be processed further so that they can be benefited better. Question number 127. Zorio's company makes joint products X and Y. 120,000 joint processing costs are incurred. At the split off point, 10,000 units of X and 9,000 units of Y are produced with selling prices of 1.2 and for X and 1.5 for Y. The units of X could be processed further to make 8,000 units of Z. The extra costs incurred in this process would be fixed costs of 1,600 and the variable cost of 0.50 per unit of input. The selling price of Z would be 2.25. What profit or loss will arise if product X is processed further? Only for X it is asked. So let's check this one. Let's take this up. The question, there are two products, of course, but the decision is only about one product, product X. So the first product, 120,000. Zorio's company makes joint products of X and Y. 120,000 joint. This is not relevant. At the split of point, 10,000 units of X are made and 9,000 units of Y. Selling price is 1.2. So there is a sale value at the split of point. 10,000 units into 1.2 is the sale value at the split of point. Then later on, this can be further processed. The units of X could be processed further to make 8,000 units of Z. The additional cost which is incurred is 1,600, variable cost of 0.50 per unit. Selling price is 2.25. So let's first find out what is the sale value at the split of point. After this, we see we have to compare that with sale value after further processing. So we also have to calculate sale value after further processing. Now, how does the processing of that takes place? So what actually happened? This 10,000 units will be made into 8,000 units. 10,000 units will be converted into 8,000 units of Z, and Z can be sold at 2.25. So there is an incremental benefit here. Incremental benefit. Incremental benefit is 6,000. Then this is possible only when they incur the further processing cost. Now the further processing cost, we see that um, there are two components of the further processing cost. One is fixed cost is there. Let's write it here, 1,600. Then they also have variable cost. Variable cost is incurred at the rate of 0.50. 0.50 per unit of the input. Input. How much is the input? The input is 10,000 units are inputted. Then the output comes out to be as 8,000 units. So then we see that 0.50 into 10,000 units. So that comes out to be as so the total for the processing cost is incremental benefit is 6,000. Incremental cost is 6,600. So now what is the option? The option will be, what's the answer? Do they have a profit or a loss? Cost is more than the benefit, which is 600 is the loss. So they should not, A is the option. So they should not be processing it further, but rather sell it at the split off point only. Okay. So that's the answer. So we'll end the class here today. The next topic what we have is risk and uncertainty. So tomorrow it will be completely numerical risk and uncertainty. So whatever are the questions we have, we would be looking into that, see payoff tables, and then the questions will be addressed accordingly. We will take it up in tomorrow's class. Any doubts? Any doubts?